Welcome back to the Kids Economy. Today we're going to be doing a follow-up lesson to our previous one that was introducing investing. If you didn't get a chance to watch that video, go ahead and watch that one and then come back. Basically, investing is putting your money into something with the hope that it will grow over time. You can do this by buying stocks, bonds, or real estate. Now, those are just some examples, but let's talk about what they are. Stocks represent ownership in a company. When you buy a stock, you are buying a small piece of that company. So, for example, if you buy a stock of Tesla, Elon Musk now works for you. And if that company does well, the value of your stock will also go up. However, if the company does poorly, the value of your stock will go down and you have the chance to lose money. Bonds are loans that you make to a company or government. When you buy a bond, you are lending your money to the issuer of the bond in exchange for interest payments. Bonds are generally considered to be less risky than stocks, but they also offer lower potential returns. So think of a bond as Elon Musk comes and says, "Hey, can I borrow $100? And you give it to him, and he promises to give it back to you at the end of the month plus $10 extra. Next is real estate. Real estate is property, such as land, houses, and buildings. When you invest in real estate, you are buying a piece of property with the hope that its value will increase over time. You can also rent out your property to generate income. Now, this might sound like a lot at a young age, and it is, but it's important to know that that concept exists. Did you know that Warren Buffett, who's one of the richest investors in the world, started his investment journey by buying a used pinball machine and putting it in a barber shop? Eventually, he put another one in there, and that's how he started his first investment journey. So why is it important? Why do we want to invest? Well, investing is important because it can help you reach your financial goals faster. For example, later on in life, if you want to buy a house, or even further down the road, you want to retire early, or maybe you want to start your own business, investing can help you get there sooner. Investing is a good way to protect your money from inflation. Inflation means that the price of things goes up over time. When you invest, your money is also growing, so it can keep up with inflation and your money can grow with the economy. So how do I start investing, you might ask? Well, the best way to start investing is to open something called a brokerage account. And this is a special type of account that allows you to buy and sell investments. Once you have a brokerage account, you can start investing by buying small amounts of different investments. So after you have an account, you might be asking, what do I invest in? Well, there are many different types of investments to choose from, so it's important to do your research and decide what's right for you. Some popular investments for kids and teens include the following. Index funds are a type of mutual fund that tracks specific market index, such as the S&P 500. Now, if all of that was confusing, just think of it as this. The S&P 500 takes the top most successful businesses in the United States and puts them into a picnic basket. When you buy a piece of the picnic basket, you're able to take a bite of everything inside. So an index like that is a good way to invest in a variety of stocks all at once, and it takes the pressure off of you from having to do so much research. The next is an exchange-traded fund called an ETF. Now, an ETF are like index funds, but they trade on stock exchanges like individual stocks. This makes them easier to sell than an index fund, which means you can buy and sell them more easily. So is investing risky? Well, in short answer, yes, investing is risky. There's always a chance that you could lose money on your investments. However, you can reduce your risk by diversifying your portfolio, which means investing in a variety of different funds and investments, just like we talked about with the S&P 500. You can also reduce your risk by investing for the long term. The longer you invest, the more time your money has to grow and ride out any short-term market fluctuations. There will be some years where you lose money, but if you start earlier, you can make that up in no time. And that's why you should start investing early. The earlier you start, the more time your money has to grow. This is because of something called compound interest, which we'll discuss later. But basically, compound interest is when you earn interest on your interest. And over time, compound interest can add up to a lot of money. So let's look at an example. Imagine you start investing $100 per month at the age of 20. You earn an average return of 8% per year. By the time you retire at the age of 65, which is a long ways away, you will have well over $1 million saved. But what if you wait until you were 30 to start investing? Well, you'll still have a lot of money by the time you retire, but it will be drastically less than $1 million. So this is why it's so important to start investing early. Even if you can only invest a small amount of money each month, it can add up to a lot over time. So we'll end this lesson with some tips for you guys. Start small. You don't need to invest a lot of money to get started. Even $10 per month can make a big difference over time. It's important to invest regularly. The best way to invest is to set up a regular investment plan and stick to it. This way, you will invest a consistent amount of money each month, regardless of what the market is doing. Sometimes the market will be high, sometimes it will be low. But you need to invest for the long term. Don't try to time the market. Instead, focus on investing for the long term and make sure that you're consistent with your plan, following the path to your goals.